Ladies and gentlemen, good afternoon. Thank you very much for coming to see us. A couple of housekeeping points. I understand that I have around 45 minutes to go through this presentation, and then I'm happy to answer any questions that you may have. As I told earlier, if I have patchy connection, I will ask you to wait for me for 5 seconds while I'm switching my laptops so that I can continue with my presentation. My name is Dmitry Zapol. I'm a tax advisor based in London. I advise owner-managed businesses, individuals and companies on various matters of cross-border tax planning. And today we are going to cover a venerable topic of taxation of UK real estate, which I think you might all find useful and interesting in your day-to-day activity. To begin with, I thought I would summarize different taxes that you or a company has to pay when you're acquiring UK real estate. You may know that in the past, I would say 5 years, there's been sea change in the way that property transactions have been taxed. First, they introduced annual tax on developed dwellings, then they've been introducing higher rates of stamp duty land tax, then the broad changes in your capital gains. And now we have a regime which is as draconian as it can be, but also which is pretty much aligned with any other property taxes pretty much anywhere in the world. Now, if we begin with talking about the taxes that a person must pay. To begin with, of course, it all starts with stamp duty land tax. As you know, there are different rates for residential and non-residential properties. And obviously, for residential properties, you pay anything from 3% to 15%. You may say that, in fact, the rates are 0 to 12%. And of course, you will be right. And of course, we have the 3% extra stamp duty land tax that we have to pay, well, an individual has to pay, if they already purchase a property while they already have a property anywhere in the world. Realistically speaking, the absolute majority of my clients already have properties either in the UK or outside of the UK, especially if they're buying, well, investment properties. So for most intents and purposes, the absolute majority of them have to pay the 3% extra tax when they acquire the property. It's always a very funny exchange with them when they ask me, so how does anyone know that I have some flat somewhere back in Russia? And I'm saying, well, you have to say this to a solicitor. And the question invariably is, and what happens if I don't say this to them? Then I say, well, then they may not find out, but it's a breach of law. You almost can see this light bulb lighting up above their head. But unfortunately, if I know that they have property abroad, then I cannot work with them if they do not declare it. Anyway, enough of that. You may know that next year we're expecting even further increase in SDLT rates, going up to 17%. Now they're saying that it will be persons who are not UK residents who are buying property in the UK who will have to pay the extra 2%. Who is a non-resident, whether you have to be in the UK less than 6 months in a year, or whether you must not be citizen, nobody knows. Clearly, if you are a UK citizen, for example, going on a work assignment abroad for a year, and you decide to buy property, how it will apply to you, nobody knows. Just wanted to ask you, can you hear me? Can you hear me okay?
Yes, we can hear.
Okay, perfect. That's it. I wanted to.
Can I ask a quick question?
Yeah, sure.
Are you going to share the slides?
Yes, of course.
Okay, cool.
I've got them already, so I will email them out straight afterwards.
Okay, cheers.
Dmitry, just quickly, is that the new non-residence tax? Is that law yet? Is that actually like?
No, it's just been a budget announcement, and there've been some preliminary thoughts on it. And I think there's soon to be a consultation on it, where they will check different ways of doing it. But it's not law yet.
Okay.
Yeah.
Thanks.
So stamp duty land tax, there are various ways how people have been offered to avoid it. There have been pension schemes, the JPUTs, QROPs, etc. But honestly, I don't believe in any stamp duty land tax schemes because invariably they hinge on the revenue missing the window to argue against the user rate. And all the agents which are promising SDLT schemes, they say, oh, we'll go to court, we'll defend you in your claim against revenue. I will not touch the barge pole. So it's something that you have to pay. Of course, however, if you're not buying the property directly, but if you're buying shares in a company, and we'll talk about it later, you do not have to pay 17 or 15% SDLT. If you're buying shares in a UK company, you only pay 0.5% of stamp duty. And if your clients are buying shares in an offshore company with UK property, then you don't have any stamp duty or stamp duty land tax to pay, period. But of course, buying a company comes with its own caveats, and I will cover them on the next slide. Now, moving on to the non-residential rates, it is anything up to 5%. And there are special reliefs called multiple dwellings relief, where you either buy 6 properties or more and you treat it as a commercial transaction, or you take the average value of the property to calculate the mean rate. Now, buying 6 properties or more could be very useful, but of course it means that your clients must have deep pockets and you must buy it in a single transaction. It's very difficult to stage it and to have a few separate transactions. Also, as I said, the anti-avoidance rules are very, very significant. Now, once you purchase the property and once you own it, I put a council tax, which is fairly insignificant, as you know. It's probably reasonable to assume that sooner or later they might increase the rate of council tax to match it, not but a 1980 something value, but to match the current value. But for now, this is it. I see that people started asking me questions in the chat. If you don't mind, I will answer them in the end because it's a bit difficult for me to focus on the slides and on chat. So I will shut it now, and I won't be reading the chat for now, but I'll look at it later, I promise. When I put taxes during ownership, I also meant if the owner wants to rent out the property. And clearly we have to pay income tax. Now, there's a significant difference between individuals who are UK resident and who are not UK resident when they're renting out the property. I will not spend too much time on defining residence, but often people think that as long as I spend fewer than 6 months in the UK, I'm not a UK resident. Well, you can very well be UK resident if you spend 90 days or even 120 days in the UK. And this is something that you should tell your clients. Basically, the rule of thumb is if anyone spends fewer than 90 midnights in the UK in the tax year, most likely they're not a UK resident. UK, then they are in the risk category and they have to consider. So the difference between residents and non-residents is that if you're a UK resident and you are calculating your taxable income, you only, if you're a UK resident, you add your rental income, your salary, your interest, etc., and you arrive at your marginal rate to pay 20, 40, or 45% tax. Whereas if you're not UK resident, when you're calculating your income tax liability, you only have to consider your UK property business. And often I'm asked questions such as, I don't live in the UK, I live wherever, Dubai, Switzerland, Russia. Why do I need to pay any tax when I receive rental income? Isn't there a double tax agreement or something? My answer invariably is there is, but because the property is in the UK has the primary taxing right. And now you can register as a non-resident landlord to receive income gross, or your estate agent can withhold it for you. My recommendation is register as a non-resident landlord, receive it gross, and just pay it. Simply because you cannot expect your estate agent to take full account of everything that you are spending on maintaining your property. Moving on to disposing of your property, I put down intentionally sale of the property and gift of the property, because in both cases you have to pay capital gains tax. It comes as a shock to some that when you are selling something, when you're gifting something, it is treated as if you have sold it at market rate. And you have to take your base cost, you have to take your current market value, and you have to calculate your capital gains tax liability. And of course, rates are much higher for your residential property as opposed to the non-residential property. Few things that I like to point out here. To begin with, if you decide, say if any of you wanted to gift me your property, you could just pick pretty much any market value which you think it will fetch on the open market. Whereas if we were relatives, the revenue will look at any market value that you use in your selling purchase agreement with great suspicion. So if you are gifting any of your residential real estate to your relatives, make sure that you get proper valuation. I'm often asked what sort of requirements the revenue imposes on the valuation companies. Do they have to be official? Do they have to be RICS, etc.? If you search online, you won't find any specific requirements applicable to the valuation company. The revenue just says that it should be market valuation, period. And as long as somebody is doing it, and they can substantiate and they have the methodology, etc., then the revenue will accept the method of valuation. The only situation when you will not have tax on disposal of UK real estate is when you're applying principal private residence relief. And they've been significantly curbing it. To begin with, you only have 9 months after you move out to benefit from the relief. And also you have to report your transactions in 30 days after you've done the disposal, and you have to pay CGT in 30 days after you've sold or gifted your property. So this is something that you should bear in mind. Moving on from sale and gifting the property to succession planning, because surprise, surprise, we have inheritance tax in the UK. And again, for those who are not from here, it comes as a surprise that if anyone living in Zimbabwe, Russia, or Dubai, or Switzerland, if they die owning UK real estate, they must pay inheritance tax, unless one of the few exemptions apply. What can be said about this? To begin with, everyone has a nil rate band, where basically £325,000 of their value of estate is not subject to tax. Of course, if we're talking about a property worth in excess of 1 million, 5 million, or 20 million, £325,000 is not going to be substantial. Of small help, the 325 has been increased to £500,000 if the total value of your UK property is less than £2 million, blah, blah, blah. But it's not really of much concern to anyone with a large portfolio in the UK. How can you plan against inheritance tax? Well, to begin with, you don't buy it, which is not really an answer. You can invest in non-residential real estate, because the difference between residential and non-residential, residential, no matter how many layers you have between the property and yourself, be it trusts, companies, etc., if the top owner dies, they must pay inheritance tax, period. Whereas if you have non-residential real estate, as long as you have a foreign company between yourself and the property, then you are protected from UK inheritance tax. But again, there's a caveat. All these exemptions are only available to those who are not domiciled in the UK. I'm assuming the listeners here, except for Natalia, may be UK domiciled, maybe not, but I'm assuming that you are. Whereas most of your British clients may be domiciled, whereas most of your Russian clients will not be domiciled. It's a question that you have to analyze well in advance of providing any inheritance tax advice. In summary, if you're not domiciled, you can avoid IHT liability in respect of non-residential property. If you're domiciled, then if you die, there's always tax. Nothing can be said about it. A few things that could be added. First of all, there's a spousal exemption. If one of the spouses died, and I meant real spouses, not cohabitees. If one of the legal spouses dies and the assets pass to the surviving spouse, there will be no tax, which is pretty good. This is why often when I meet clients in meetings, I ask them, are you guys married for inheritance tax purposes? And normally they say no. Well, often they say no, and I say, well, your best tax planning strategy is to get married. It came as a surprise to me why so many Russian couples are not married. And it turns out many Russian husbands are scared of British divorce laws. And this is why they prefer to be as cohabitees. Anyway, one more thing that you can try is that if a person dies, if they don't have any assets, they don't have any tax to pay. So a common strategy is to gift your property and not have any assets when you die. But of course, there are rules against it. More particularly, you must survive for 7 years after making the gift. In other words, when you die and when you calculate the value of your property, you include the value of properties gifted in the 7 years before death to prevent the so-called deathbed planning. So again, ask your clients if they've made any disposals. But of course, you could also purchase inheritance tax insurance to avoid tax liability. Moving on to the next slide, we are now going to cover corporate ownership. In terms of stamp duty land tax, the main difference is that, I'll go back a slide for a second. If you are an individual, you have a scale of stamp duty land tax from 0 to 12 or from 3 to 15, depending on the value. Whereas if you are a company, if you're purchasing a property worth in excess of £500,000, you must pay 15% stamp duty land tax, period. No two ways around it. As far as I know, there are no plans to impose additional 2% on the companies in 2021, but this can be changed and companies may also have to pay the additional 2% rate. Other than that, same rules apply to multiple dwellings relief, and obviously if you're paying for your non-residential property, stamp duty land tax is much smaller. Now, I mentioned earlier that you can avoid stamp duty land tax by purchasing shares in a property owning company. It's a common strategy, especially, I guess, going to legacy properties, which have been in the corporate ownership since early 2000 and onwards. It's very good to buy a property like this because you avoid SDLT. But the main problem with that is that together with the company, you're buying all its potential liabilities, such as if the former director took out a loan or issued a promissory note, any of the creditors can come and request it from you. This is why you need very good lawyers who will arrange all the reps and warranties for you. But of course, a rep and warranty is as good as the person giving them. So you might run into trouble or ask for the financial due diligence and legal due diligence of the property. Sometimes I'm asked whether it is a good idea prior to selling the property to the buyer to transfer it into corporate ownership so that the buyer saves on stamp duty land tax. It is possible, but let's not forget, when the seller transfers the property into corporate ownership, he must pay stamp duty land tax. Therefore, it's really a commercial point and passing the liability between each other. Council tax, you have to pay not really council tax, but it's business rates. If it's commercial property, I won't dwell too much on it. Annual tax on developed dwellings. They've introduced it in 2014, 2015, and it has been going strong ever since. Now, the top rate of annual tax on undeveloped dwellings. Sorry, I'm just assuming that you know what ATED is, but let me just summarize it. ATED, annual tax on undeveloped dwellings, is an annual tax that a company must pay if it owns UK residential real estate. Initially, this was introduced to deter corporate ownership of residential property because at the time, it would allow you to achieve significant inheritance tax benefits. Now, corporate ownership does not give you any benefits, however, ATED still remains. So the lowest rate of annual tax on undeveloped dwellings is about £3,500 for properties up to 1 million in value. It goes up to 236,000, I think, for properties worth 20 million pounds or more. Now,
Dmitry, quick question. Does that apply, the ATED, even if the property is just rented out? Or is it applied to all corporate ownership? What if you rent it out on a commercial?
Excellent question. I was just going to cover it. If it is part of a property rental business, more particularly if you're renting it out to a third unconnected party on commercial terms, then no ATED applies. What can I say about this? If you have a property and you transfer it into your own company of which you are a director or a shareholder, you cannot rent it out yourself because you are connected with the company and the company will pay ATED. Whereas if you're starting a proper property rental business, then of course you'll get the exemption. But to get the exemption, every year you must file a return. Also, every other year you must check the valuation of the property. And this is what some people are forgetting, that even though you're exempt from paying tax, you still must file a return and claim the exemption. Now, going back to this discussion about whether it's worth paying ATED or not, if you have a property, say, of, I don't know, 5 million, you pay a couple of thousands of ATED every year, and you live in this property. Why would you still want to have corporate ownership of property? Well, we will talk about this later, but in summary, you may achieve lower tax. Actually, no, sorry. You're only paying tax, you're only paying ATED if you own the company which owns the property. So what would be the benefit of someone holding his own property through a company? There are two benefits of doing this now. First is that in the future, when you're selling your property, the buyer will not have to pay SDLT, as explained earlier, and this could give you commercial advantage because you're paying ATED every year, but later there will be significant saving. Or you could keep it in a company to keep your ownership of the property confidential. Let me first cover the first point, then I'll move on to the second point. £238,000 a year or whatever is a large sum of money for any sort of property. But if we're talking about a 40, 50 million pound property, this sum is fairly insignificant. It will take you 15, 20 years to match the amount of ATED with the amount of SDLT that the buyer would pay when purchasing the property. So clearly it's worth for you to pay ATED for a few years and then sell the property and achieve a good price. Otherwise, there isn't much savings. It's all about maths. Regarding the price that you're paying for your privacy, it's a very, I guess, philosophical point. How much you're prepared to pay to keep your ownership confidential. They're promising to introduce the register of beneficial ownership of property next year or in 2 years' time. When this is done, all of this will be for nothing. You will no longer be able to hide yourself behind the corporate wrapper. Also, you may know that even if you hide yourself, it can be easy to find your name. For example, if you search somebody's name, they can be on the committee of the property management company. And of course, it's very easy to match the property management company with the property which you're managing, in which case this is all useless. Halfway of achieving your privacy would be to use a nominee company. What you do, you register a company, Jersey, Guernsey, Isle of Man, wherever they don't disclose ownership of owners, wherever they don't disclose ownership of companies there. Such companies acting as your bare trustee, as a nominee of an individual owner, and for the price of 4 or 5 register will become live in the UK. In other words, whether to pay ATED or not, it's all a question of mathematics and how much you're prepared to pay. Now, if a company is renting out the property, it is paying a flat rate of corporation tax, 19%, as opposed to the progressive rate of individuals, 20, 40, or 45%. And this can be very significant. I tend to work mostly with non-resident clients. And for them, it's very cost effective to have a UK company which only pays 19% corporation tax, and then there's no tax on dividends. Whereas, of course, if you are working with UK resident clients, then of course you have to take into account their own personal taxation when they're extracting profits from the company. I will be talking about it in a bit more detail on a few next slides. Corporation tax on disposal of the property, also 19%, which is pretty good. Succession. If, as I said before, if you are not domiciled in the UK, you can use a wrapper, a corporate wrapper between your, say, your shop and yourself. You can use a foreign company, okay, it's you, foreign company, UK non-residential property. In this case, if the owner dies, the corporate wrapper will act as a blocker and there will be no inheritance tax liability. However, you cannot do anything about residential property. No matter what you do, no matter how many layers you include, if the owner dies, there will be inheritance tax to pay. Trusts could offer limited relief, but the problem with trusts is that if you transfer property in the trust, there's an entrance charge of 20%. If you do not exclude the settlor, it will be settlor interested trust, again, 40% tax on their death. If the settlor is excluded from beneficiaries, the trust is subject to its own taxation. Every 10 years, you have to pay 6% tax on the value of the property, and then there's a 6% exit tax. So no matter how you put it, inheritance tax on residential property is very bad. What can you do? You can take out a loan to purchase, but it's very tricky. Now moving on to just making the choice, I've tried to put it in orange, the low, high risk, and green, lower risk. Clearly, residential property is more expensive to buy and you have to pay inheritance tax. Whereas for commercial property or for multiple residential properties, you can achieve lower SDLT and can also achieve inheritance tax opportunities. Commercial wins. Personal versus corporate ownership. Of course, it depends, but if we're talking about investment property, probably corporate ownership is much better. If we're talking very small, if we're talking about small apartments somewhere in Manchester, and you have a non-residential owner, and the rental income every year is, say, £20,000, of course, using direct ownership, owning it personally is much easier. But if you're talking about large portfolio of assets, corporate ownership gives you much better tax opportunities. You pay a lower tax on disposal, you pay a lower tax on rental, and you can achieve inheritance tax advantages. In summary, strictly from the tax point of view, it's always better to own commercial property through a corporate wrapper, but you have to marry this with your non-tax but with your business choices. Now, just a quick summary of taxes that the individual landlord would pay. I've said before, you have to pay SDLT when you are acquiring a property. There's not much to add to what I said before. When you are calculating your rental income, you normally have access to income tax allowance, and this may come as a surprise, but if you're not UK resident, you may also have income tax allowance. You have very, very limited opportunities to reduce your taxable income by the amount of mortgage interest. Basically, instead of the possibility of reducing your rental income, you're getting the so-called 20% tax credit. But so in reality, you can only get any deduction of your mortgage costs if you're a basic rate taxpayer. If you're a higher rate taxpayer, it's useless. Typical current running expenses are deductible, such as current maintenance, council tax, small repairs, etc. But of course, if you want to add a kitchen or to conduct large-scale repair, this will be a capital cost. You can only deduct it when you're selling the property. I mentioned before that when you are selling or gifting the property, you have to pay capital gains tax. subject to the principal private residence relief, which has been substantially limited. Now it's down to 9 months, 18 months, and if it's been rented out commercially, it is not always available. I've separated UK resident landlords and non-UK resident landlords. What are the differences? To begin with, if you're not resident in the UK, then you calculate your rental income just on the basis of your UK income. You don't take into account what you're receiving from abroad. And of course, you have to register for self-assessment. One interesting point, though, is that if you are a resident in the UK and you are selling your property, you have to pay the full rate of CGT on the total increased value. If you're not a resident in the UK, you have the opportunity to bring up your base cost to the value in 2015 or for later years in some cases, in which case this would give you substantial CGT advantages. But we must not forget that you, as a taxpayer, is not an island. And you must take into account not just taxes in the UK, but also taxes in wherever you may be living. Corporate landlords. I've said enough about stamp duty land tax. Just one comment regarding the purchase of shares, because you can clearly avoid stamp duty land tax when you're purchasing shares. But of course, there are lots of undisclosed liabilities. Corporation tax. And what's more advantageous if you are a corporate landlord is that pretty much you will have almost a complete relief for your interest expenses. Why I'm saying almost a complete relief is that you can deduct without a problem up to £2 million of interest costs. If we're talking about a large corporation which has taken out a loan where interest expense is over £2 million, then you cannot fully deduct it. But most of my clients, they're taking reasonably small mortgages for which £2 million of interest expense is quite significant. So it's all right for them. They've brought up the base cost to the 2019 value. So again, this is advantageous when a company is selling UK property, residential, non-residential. So what planning is available when you're using a corporate landlord? To begin with, as I said earlier, if you're not UK domiciled, you can use an offshore company to own non-residential real estate to avoid inheritance tax. Also, if you are a UK resident, it's kind of obvious, but I'll say it nonetheless. If the company is paying corporation tax, you have a tax deferral until you pay yourself dividends or salary. And if you own it with your spouse, with your children, you will achieve substantial tax saving on extracting money from the company. And of course, for non-resident landlords, it's much cheaper to rent out commercially because, as I said before, to rent out through a company. Because the company would pay 19% corporation tax, and then you would not pay any income tax on withholding. You will not pay any withholding tax on dividends being paid abroad.
Dmitry, quick question. Sorry, because otherwise, you're recommending corporate ownership if the property is rented, but surely if you buy in a corporate, would you not have the 15% stamp duty plus potentially an extra 3% for a buy-to-let or maybe non-resident? So you might be paying 17% stamp duty if you put it through a corporate ownership.
Yeah.
Sorry?
No, you are.
Huh?
Yeah. Taxes should not be taken in isolation. And I'm talking about, say you are a client and you have a choice of whether to buy the property in your name or somebody is selling you a company or somebody is selling you a property business. Of course, you're absolutely right. If you're facing a choice of whether to buy it in the company's name or in your own name, of course, stamp duty land tax will have to be
Dmitry,
paid. I absolutely agree.
Can I ask a question? You said if it's a company,
Yep.
And if it's in shares, you don't pay the stamp duty.
If you are buying shares of a non-UK registered company, you do not pay UK stamp duty.
What about if I am buying the whole company
Yes.
in shares?
Yes.
Am I still exempted?
Are you buying a UK company or a non-UK company?
If it's if the company is registered as a non-UK company,
Sorry,
and I'm buying the shares,
yeah, if you're
the
buying,
company,
if the company,
but if I'm buying 100% of that company,
yes, if you're buying shares
does that?
If you're buying shares of a company registered in the UK, you pay 0.5% stamp duty. If you're buying 100% shares of a company which is registered outside the UK, you do not pay any stamp duty in the UK.
Okay, cool. Cheers.
Dmitry, is there non-exemption? If I buy a company, if I put a property in a company, and all I'm going to do is rent out that property, so it's a business, are you sure I still have to pay the 15% stamp duty because it's just a business?
In other words, you're asking whether you could get an exemption from 15% when you're putting the company into the corporate wrapper.
No, I'm just saying, let's say I want to buy a property which is a buy-to-let property, and I put it in a company name. Okay, so the company buys the buy-to-let property.
Yeah.
Are you sure I'm paying 15% stamp duty because it's just a rental? It's a business. It's a rental property.
Simon, what is the value of the property?
Well, let's say £1 million. I'm not, you know, because it's just. Is there not an exemption for property companies or development companies?
You're right, there was an exemption for when you were entering into the rental business. You would pay a lower rate of stamp duty land tax. You're right. Have not looked into it recently.
Okay.
Most clients have already been paying it for their personal use. This is something that I could check for you and drop you a line later, if you wish.
Okay, thanks.
Yep, I will research and send it to you. Just finishing up, I wanted to touch upon inheritance tax, which I've pretty much covered. When you're talking about residential property, it may come as a surprise that if you inheritance tax applies not only in respect of people owning residential property directly, but it also may arise to a person who lent to the buyer and whose loan is secured of the property. In other words, if you have a relative who lent you some of money to purchase this property, the value of the money lent will constitute his inheritance tax liability on his death. Also, if you take out a mortgage, you can reduce the net value of your property, and you pay less inheritance tax. But you must obviously take out a mortgage when you are acquiring the property. Whereas if you take out a loan later, and even if you secure it over the property, you will not get any inheritance tax planning opportunities. So what I'm normally advising about inheritance tax planning, to begin with, always better to buy non-residential property if you're not from the UK. Take out a mortgage, make a will so that the husband wills the property to his wife and the wife wills it to her husband. That's why essentially buying time if one of them dies. You can also put the property into your joint names with the children, because effectively you're spreading the risk and you can claim multiple nil red bands. But if your children are minors, you may not want to do it. And you can take out inheritance tax insurance. And just to finish it up, I've been saying a lot of things about buying non-residential property through a non-UK company. What can be achieved is that you register a company in Jersey, for example. So it's a foreign registered company, but you register it for corporation tax in the UK. So it becomes a UK corporation taxpayer, thus achieving all the benefits of taxation. I think I have used up my time allocation for this presentation. Would you like to ask any questions?